When we form a partnership, we will contribute something to the partnership. Maybe we contribute some cash to the partnership. Trinity and I go into business together, and each of us is contributing $5,000 so that we've got some startup money, some money that we can use to get started in our partnership, right? We can buy assets with it, we can buy supplies with it, we can do all sorts of, whatever we can do with $10,000 to get ourselves up and running and off the ground. So cash is one way that we might start a business. We might also contribute assets to the business, to the partnership. So maybe Trinity has a truck that's worth $5,000. So that's what she contributes. And then I contribute cash worth $5,000. If this is and in this example, we've got kind of an equal partnership going. So we could contribute, you could contribute some sort of asset as well. In addition, maybe you don't have any assets, maybe you don't have any cash, but you got some sort of skill set that you can contribute to the partnership. So now we're gonna have a partnership. We're gonna let somebody else into our partnership. Trinity's contributed the truck, I've contributed $5,000, and Sam has contributed her services. Sam is an expert, let's say we have a landscaping business. I think they use landscaping here, don't they? Lawn and landscaping. Sam has some expertise in landscaping, and so she is going to contribute her services to the business. You can do that. It doesn't have to be the same. Each person doesn't have to contribute cash. Each person doesn't have to contribute exactly the same item, right? There are different ways that you can contribute. So here, what happens is when you contribute cash, all you're doing is transfer. It's like depositing money into your bank account, right? $5,000 goes into the bank account. It's still your money. It's money that's already been taxed. You don't have any gain or loss on that. But what it does is that $5,000 cash now is part of my partner basis. Okay? It's part of my ownership in that partnership. So we contribute something, cash, property, or services, in exchange for a partnership interest. So in our example with Trinity, Sam, and I, each of us gets 33.3% of the partnership. Actually, somebody's going to get 33.4%, but 1/3, 1/3, and 1/3 of the partnership. And we have an agreement. This would be part of our partnership agreement about what each person's going to contribute and how much ownership each person has in that partnership. Okay? Now, there are two types of, like I said, this is part of our basis, right? It's what essentially we're like buying a portion of that partnership with these items. There are two types of basis though. One of them is called the outside basis, and one of them is called the inside basis. So the outside basis is the basis of the partnership interest in the hands of the partner. The inside basis is the partner's share of the basis of the individual assets in the partnership. So outside basis, partners. So partners, how did they word this? Basis of the partnership interest. And this is the partner's So for example, so the three of us have formed a landscaping company. Sam has contributed $5,000 worth of services. Trinity has contributed a truck that's worth $5,000. I have contributed $5,000 of cash. All right, well, when we transferred the truck into the partnership, it's no longer your truck, it's the partnership's truck. We own the partnership 1/3, 1/3, 1/3. So now, for all of us, our inside basis is 1/3 of the value of that truck. Also, 1/3 of the value of the cash, if we haven't spent it, is now part of our inside basis. Because each of us owns 1/3 of those assets. Now the services aren't an asset that have been contributed, so they're part of Sam's outside basis, but they're not included in the calculation of our inside basis. So again, we've got, 5,000 cash, and Trinity truck that's worth 5,000, and Sam services that are worth 5,000. But this isn't an asset. These two are assets. So our total assets, our total inside basis is $10,000, right? And we each own 1/3. So our inside basis, 10,000 divided by 3, so 33, 33, 33 for each of us. But our outside basis is our share of the partnership interest. We each contributed 5,000, something worth $5,000. So Kelly is 5,000, Trinity 5,000, and Sam 5,000. So you can see our inside basis is 10,000, but our outside basis is in total 15,000. Again, we each own 33% of that business. So our beginning basis is going to be based on what we put into the partnership. Before we've done anything with the partnership, it's going to be based on that. So let's look at this example here of inside and outside. So Bart and Alan form an LLC to construct personal residences. They're 50-50 partners. They share an income and loss items 50-50. Bart is contributing undeveloped land and equipment. The basis of these items to him, $55,000 and $35,000. But they've got a fair market value right now of $150,000. Alan is contributing $90,000 of cash, $30,000 of office equipment, and a truck that's worth $5,000. So the basis of all of those items to Alan is $125,000. Fair market value of those items is $150,000. So you can see they're equal because the fair market value is the same for each of their contributions. They're 50-50 partners because the fair market value is the same. So outside basis in his partnership interest is $90,000, $90,000, the sum of the contributed assets. Outside basis to Alan is $125,000, the sum of the contributed assets basis. So that's what their individual, so just like here, because I contributed, this one's worth $5,000, their outside basis, this one. The fair market value of those items. See, in my example, the fair market value is equal to the basis to each individual. All right. because the fair market value of these items for each of them is 50%. So if Bart were to sell his partnership interest with a fair market value of $150,000, he would recognize a $60,000 gain. So the amount of the basis of the items that he contributed. So whatever the basis was to the contributing partner is the basis within the partnership. And so if once the partner disposes of their partnership interest, any gain or loss is going to be based on that, because they can't, and that is to try and, otherwise what would happen is people would use the partnership as a way to avoid any gains on assets, right? So if I've got $10,000, I paid $10,000 for some stock and I transfer it into my partnership, or that's not a very good example, stock. I have a building and my basis in that building is $20,000. The fair market value of the building is $200,000. If I were to sell that building for $200,000, I'd have a $180,000 gain. Well, just because I transfer it into a partnership and then the partnership sells it doesn't mean that I get to forget about that gain, right? I'm still going to have to pay the gain at that point, or when I dispose of my partnership interest. So you can't avoid any of the gains just by transferring property into a partnership. Let's see. So a partner's basis in their partnership interest, the outside basis is the sum of any money contributed plus the adjusted basis of any property contributed. So let's look at Dave and Alyssa here. They form a law partnership. Dave gave $100,000 cash. Alyssa gave $100,000 of unrealized accounts receivable from her sole proprietorship. So obviously Alyssa was an attorney before, and she had clients that owed her $100,000. So instead of now those clients owing her $100,000, they owe the partnership $100,000, right? But they haven't been realized yet. They haven't been collected yet. Dave has a partnership basis of $100,000. Alyssa has zero basis in her partnership interest. Even though she gave something of value for a 50% interest, it has zero basis. So as they collect, though, on those receivables, that would increase her basis in the partnership. All right. Basis in, basis out. Assets contributed to the partnership have a tax basis for other purposes, such as depreciation, right? That truck that we got from Trinity, we're gonna have to depreciate that truck. What's our basis in that truck? What are we gonna use to depreciate it? What amount are we gonna use as our basis for depreciation? So we're gonna use whatever Trinity's basis was. Essentially, the partnership steps into the shoes of the partner. So the basis in the hands of the partnership is the same as the basis in the hands of the partner. So that truck, like I said, that truck was $5,000 to her, so now it's $5,000 to the partnership. This is an example of the tax basis balance sheet as opposed to a financial basis balance sheet. So this is Alan and Bart, okay? This is everything that they've contributed to the partnership. You can see we've got assets that have been contributed, but the basis of those assets is going to carry through to the partnership. So this undeveloped land, even though it's got a fair market value of $100,000, on the balance sheet, for the tax basis balance sheet, it's gonna retain that $55,000. Truck, $5,000. So these just carry over in the amounts that were contributed. And then the capital accounts, that's their inside basis. Inside, right? Outside, sorry. And their outside basis are the capital accounts. So we don't have any liability at this point. Our assets are equal our equity. For depreciable assets, partnership assumes the depreciation schedule of the partner at the point of the contribution. So, if the partner's in the third year of depreciation and contributes that asset to the partnership starts depreciating it in the third year. It's as though nothing changed. Right? A personal use asset is contributed for business use. So let's just say Trinity, that truck that she contributed was her personal truck. Partnership's basis in the asset is the lower of the partner's cost or the fair market value on the date that it was contributed. So whichever is less. This is if it's personal use. If it's business, if it was a business asset, then we're gonna go with whatever that adjusted basis is. So here is an example. Jose contributed a piece of equipment to JWS Partnership March 1st. The cost of the equipment was $20,000. Year 21 was the third year of depreciation. So what we're gonna do is we're gonna step into Jose's basis. And we're just gonna pick up on the depreciation as though nothing happened, right? It's not treated like a new asset, it's treated the same way Jose was treating it. So whatever, and this was March 1st, so Jose would, on his Schedule C, would get to depreciate it for 2 years. And then the partnership would start depreciating it as of March 1st, so we would get 10 months of that depreciation. Now here, Jose also contributed a truck that he had used personally for 4 years. So this is not a business asset, it's a personal asset. It was $28,000 4 years ago, but its fair market value is $8,300. The basis to the partnership is therefore gonna be $8,300. Okay? And it would start you would start at year 5. Not year 5. You'd start depreciating it from the start for 5 years. If it was a personal asset. Okay, so this is for assets that are then transferred into the partnership. There's a difference between if it was a business asset, in which case you just continue on depreciating it as you were, or if it was a personal use asset, in which case you're going to use the lower of the cost, original cost, or the fair market value, because remember that item has not been depreciated. It was personal use, so it was never depreciated. You're gonna take the lower of the original cost or the fair market value, and then you're gonna start depreciating it as though you had just purchased it. Right? Questions? Alright. So, holding periods. Remember, we have these holding periods, so it could be short-term or long-term. If you think back to chapter 7, with those 1231 assets and capital assets and all that fun stuff, it depended upon how long we held the asset, right? So, generally speaking, the holding period of the partnership includes the holding period for 1231 assets and capital assets. So, if the truck, let's see, capital assets would be a personal use asset, but if that truck, the the truck would be a 1231 asset. If it was held for 3 years, then we're gonna start, the holding period is 3 years for the partnership. If ordinary assets are contributed, inventory, accounts receivable, the holding period of the partnership begins on the date of transfer. So it's gonna be short term. Okay. Now, the partnership itself has its own basis. It has its own holding period. Partnership holding period for, let's see, the same holding period holds true for the partnership. Oh, I'm sorry, I jumped ahead here. We're talking about the partnership as an asset. So that carries over to the partnership. So here we've got an example. Casey contributed these assets to a partnership June 5th. Building and inventory. So the building is 1231 asset. It was purchased July 1st, 2012, so the holding period is going to be, for the partnership now, starts July 1st, 2012. However, the inventory is an ordinary asset. Even though it was purchased May 8th, 2016, the holding period for this is going to start June 5th because that's the date of the contribution. So, when we're contributing cash or contributing property, the partner themselves doesn't recognize any gain at that point. All they've done is transferred it, like I said, it's like putting it into a bank account. You transferred the item, the asset from one account to another account. Right, so there's no recognition of gain at that point. Services contributed are a different story. So remember, Sam contributed $5,000 to services. Sam is gonna have to recognize some gain on those services. When you form a partnership, partner providing services will recognize income to the extent of the fair market value in their partnership interest. The whole idea of basis is it's something that's already been taxed. And so, therefore, when you get rid of it, you're not gonna be taxed on it again. Well, if Sam is contributing services in the amount of $5,000, she hasn't been taxed yet on those services, right? So now when she contributes those services to the partnership, she is going to be taxed on that. And at that point then, that increases her basis in the partnership. So here we've got Russell, Kevin, and David forming a partnership. David is an expert construction contractor. Russell and Kevin each contribute either cash or property. So Russell's contributing land, Kevin is contributing cash. David doesn't have any money, but he has expertise. So David agrees to perform all the work to develop the land into a high-end subdivision. So Russell's land has a basis of $200,000. Kevin's cash has a basis of $300,000. David's services, how are we going to value that? Now, their partnership percentages are listed here. This is given to us. So Russell owns 30%, Kevin owns 30%, David, his partnership interest is 40%. David is going to recognize $240,000 of income. How do we get to that $240,000? Well, we're going to take the fair market value of all of the assets contributed and then multiply that by David's partnership percentage. So they contributed, fair market value is $300,000 for each of those, $600,000 total. We're going to multiply that by 40%. David's ownership percentage. So now he's going to have to recognize income of $240,000 that he didn't get, but he didn't get the income on whether it was personal use or whether it was used in a business. If it was used in a business, then we're going to take whatever the adjusted basis is, and we're just gonna continue on as though nothing ever happened. Just transferred from the left hand to the right hand. If it was personal use, however, whatever is less the fair market value or the cost of the asset is going to be then the basis to the partnership, and we're gonna start that depreciation from day one. If it's services, we're gonna value it as the sum of the fair market value of all property contributed times the ownership percentage of the contributing partner. But they are gonna have to pay tax on it. Alright, now let's add another little wrinkle here. Contributed property with liabilities. So let's say we'll go back to Trinity's truck. She contributed that truck. It was $5,000, but she still owed $2,000 on it. What do we do then? Now, if the partner is released from a liability, they're treated as though they received money from the partnership, which reduces their partnership basis. So essentially, the fair market value of that truck minus any liability that she is released from. If the other partners assume a portion of that liability, they're treated as making a money contribution, which increases their basis. Here's an example of that. We've got Angie. So Angie contributes an office building. In exchange, she's getting a 25% interest in a partnership. Instead of owning the building, she owns part of the partnership. The building has a $300,000 fair market value and a $160,000 basis. It is subject to a $100,000 mortgage, so she's already got a mortgage on it. What's going to happen is she's going to transfer the building to the partnership. The partnership now is going to take over the mortgage. So now Angie doesn't have to pay the mortgage. She's released of that liability. Partnership assumes the mortgage. Each of the other three partners contributes $200,000 of cash. So, cash is easy, right? Maria, Bess, and Kylie, they each contributed $200,000. Angie, it's going to be the basis. Remember that basis just transfers over. It had a $160,000 basis. The $100,000 mortgage is going to get spread amongst the four of them equally because they're equal partners. So each of them is going to assume 1/4 of that mortgage. That increases all of their bases. Only Angie was relieved of a liability, which is going to reduce her basis in the partnership. So Angie's partnership now is our partnership basis is $85,000. The rest of them have a partnership basis of $225,000. Which means if Kylie turns around and sells her partnership percentage to somebody else for $250,000, she's going to have a $25,000 gain, right? Because her basis was $225,000. If Angie sells her partnership interest for $250,000, then she's going to have a gain of what? 250 minus 85 is, somebody do the math for me. I can't think that fast in my head. But her gain is going to be much higher than anybody else's. Okay. Basis, partner basis can never go below 0. Can never go below 0. This also means that if Kylie were to get some cash out of the partnership, say she gets $100,000 of cash out of the partnership. That will reduce her basis to $125,000, but the cash, the $100,000, is not going to be taxable to her. Because it's just, this is her money in the bank, she's withdrawing money from the bank, right? It's still her money. It's hers, it's not income. However, Angie, if she gets a distribution of $100,000, 85,000 of that was already hers, but the other 15,000 was over and above what her basis was. I mean, she's gonna have to pay tax on the 15,000 because that is what's income to her. And essentially what that does, so we have our beginning basis, and I'm getting a little head here, but which consists of amounts contributed upon formation, right? Contributions, formation. So she contributed 160,000 and then 25,000. So we're gonna say her basis is 85,000 right now. Remember, this is a running tally. So as time goes on, her basis is going to be adjusted. It's going to be increased by income, net income. It is going to be increased by contributions, additional contributions. And it's going to be decreased by distributions. And losses. So she starts out with 85,000. Let's say they had income this year of 15,000. And then Angie decides to contribute some more cash. She put in another $10,000. But she withdraws then $50,000. Okay? She gets a distribution of 50,000, and we had a gain this year. We had income, so we didn't have a loss. Her ending basis is, what is this, 110 minus 50 is $60,000. So now her ending basis, which also becomes for next year's beginning basis, is 60,000. Next year, there's no income. There's no contributions. She has another distribution of 50,000. But they have a loss of 15,000. Well, now we're negative $5,000. We can't do that. This has to be zero. So essentially what's gonna happen is she's gonna pay tax on, essentially it's as though that is income. That's gonna be treated as income, taxable, which income increases basis, right? So she's gonna pay tax on that. That brings her back to zero. And then the next year, she starts out at zero. And it goes on and on and on and on and on. If she were to sell at this point, say she sold her share for $20,000, she'd have a $20,000 gain because her basis is zero. If she sold here for $20,000, she'd have a $40,000 loss because her basis is $60,000. Okay, I'm kind of getting ahead a little bit. We're going to be discussing that a little bit more here. So yeah, when you contribute something with a liability and you are released from that liability, you now, it's as though you got a distribution, right? And distributions reduce basis. Because now you don't have to pay that liability. You know, not having to pay $100,000 and receiving $100,000 are the same thing. If you think about your personal balance sheet, it's the same thing. You're reducing your liabilities, that's the same thing as increasing you're still gonna increase your equity, right? Okay. Now we've got the same facts, except that the office building, the basis of the office building is $45,000. So her beginning basis is $45,000. We get to add her share of the liability, because she's gonna be responsible for 1/4 of the $100,000 mortgage. $25,000, subtract her liability release, well now she's below zero. She cannot be below zero. So in order to get her back up, she's going to have to recognize income, which raises her basis. Recognize that income of $30,000 to get her basis up to zero. So the only time a partner recognizes a gain is upon contributing services or when a partnership assumes a liability in excess of basis. This is formation of the partnership, so just getting it started. Questions? Ordinary income or loss. We should probably look at them. Where's the key one? Alright, so again, think about a partnership as essentially it's a sole proprietorship, but it's owned by more than one person. Okay, so think all the rules that went along with sole proprietorship. A lot of these complex basis rules and other rules that are associated with partnerships are meant to equate a partnership to a sole proprietorship, but a sole proprietorship that's owned by more than one person. So remember, we had with our sole proprietorship, we had net income, right? At that line 31 on the Schedule C, that was our net income. That was the income that was subject to self-employment tax, and it was subject to income tax, right? Well, and any other types of income, dividends, interest, rental income, all that stuff was going to show up in other places on the tax return. So it's kind of the same. It's the same concept with the partnership. Oh, and actually, I forgot to put down. So remember the partnership tax form is called the 1065. I think I mentioned that earlier in the semester, but I should probably just remind you guys. So the ordinary income or loss, if it's a sole proprietorship and we have ordinary income or loss, it's going to be subject to self-employment tax. Well, just because it's we have a partnership doesn't mean that it should no longer be subject to self-employment tax, right? Because again, a partnership, at least a partnership where the partner is contributing their services, is like a sole proprietorship. It's just with more than one person. So that ordinary income or loss is going to be subject to self-employment tax to the partner. Okay. Now, if the partnership is viewed as an investment to the partner, that's a different story. Then that ordinary income is not viewed as, it would not be subject to self-employment tax. This is only when they're actively engaged in the operations of, they materially participate in the partnership. Okay, the partner is, through their actions, is contributing to that partnership earning money. So, what happens when we've got a partner who is drawing a salary? Remember I said that partners can't be employees. A partner cannot be an employee of their own partnership. Partnerships can have employees, but the partners themselves are not considered to be employees, they're partners. But oftentimes, partners will still draw a salary from their partnership. So, if we think about my blue pen, let's say we've got a partnership that, I don't know if I want to do this from the partner's perspective or the partnership's perspective. I'll do it from the partner's perspective. So we've got partner one, and they're a 50% partner. And the partnership, ordinary income, before any salary earned by the partner, I'm just going to use one partner as an example, was $100,000. Partner one is a 50% partner, and they have a salary of $20,000 from the partnership. Now, it's not called a salary, it's called a guaranteed payment, but it's like a salary, okay? So guaranteed payment. All right, under these circumstances, if we didn't have that salary, partner one is going to claim $50,000 of ordinary income. It's all going to be subject to self-employment tax, right? Actively engaged. This salary, though, gets to be counted as a deductible expense to the partnership. So now it's $80,000. This partner is going to get 50% of this. Their partnership share, so $40,000 is going to be the ordinary income. But they're also going to have to claim this guaranteed payment as income. It's a deduction to the partnership, but it's income to the partner receiving it. And it's going to be subject to the self-employment tax. So the other partners are going to benefit from this because it's going to lower their ordinary income, right? The fact that they're paying this other partner $20,000 helps to lower their ordinary income. So the other partner, let's say the other partner doesn't have a guaranteed payment. All they're going to have to claim as income is the 50%, $40,000. This partner has $60,000 of income. So that guaranteed payment, it is subject to self-employment tax, but it reduces the ordinary income of the partnership. So here they've got a couple of examples as well. Now it has, let me back up a second. There are some requirements for it to be considered a guaranteed payment. It has to be in exchange for services, so they have to actually provide services to the company. And it cannot be dependent on partnership income. So they can't say, it has to be, okay, you're getting paid $20,000. Or it could be an hourly rate, you're getting paid $20 an hour. It cannot be, okay, you're gonna get this if we have positive, at least $50,000 of net income. Or you're gonna get 10% of our net income. That means it's no longer a guaranteed payment. The guaranteed amount, you get paid whether we have the money or not. Which, if we don't have the money, that means we're gonna have to borrow it to pay. Okay, so it's gotta be calculated without regard to partnership income. So we got Junius, 20% partner in DJ Real Estate, does a substantial amount of work for the partnership, receives $1,000 a month for his services. This is considered a guaranteed payment. So the partnership will deduct it from their ordinary income. And Junius includes $12,000 of guaranteed payment on his Form 1040, and it will be subject to self-employment tax. Here we've got Donna, 80% partner in that partnership. She works for the partnership, receives a monthly payment of 50% of the net income for the month. Because it is calculated with regard to partnership income, it is not considered a guaranteed payment. Therefore, the partnership does not get to take a deduction for that payment. And what happens is, for Donna personally, that payment is then going to reduce her basis, because that's considered a distribution. So remember, over here, we've got beginning basis. I'll just put this up as a reminder. Plus income, plus contributions, minus losses, minus distributions. Ending basis. Can't be below zero. Okay, so if this was not considered a guaranteed payment, if this was just $20,000 that was paid, then it becomes a distribution. Distributions reduce basis. Okay? But because it's a guaranteed payment, essentially what it's doing is it's reducing our ordinary income. It is going to reduce it's going to actually, well, it is going to reduce basis because it's reducing income, but not by the full amount. And it's going to reduce everybody's basis. All right, because our net income, I should say, net losses. This is what the tax return looks like. This is the 1065. Again, so it's very similar to an income statement. And it's very similar to that Schedule C, at least the first page of it is. We've got gross receipts, all that, our gross profit. Here we have cost of goods sold, we would include that in the calculation. Total income as well. And then all of our expenses, the deductions, salaries, wages, guaranteed payments to partners. The items right there. Bad debts, chances are we're not going to have that because we're probably cash basis, but if we're not, depreciation, all of those same types of deductions, and the rules are the same. The rules as far as ordinary and necessary expenses, that's all the same. The depreciation rules that we've gone over, all the same for partnerships. Okay. of these are just, questions about the entity. I mean, the actual income and expense information for the most part is here. And then there's questions about the entity that help to determine certain, remember I said that the partnership taxation is complicated? Look at all these different questions that relate to different rules for partnerships. Sam is shaking her head, no.
No, I wouldn't wanna do that.
Not interested. And then what we have here is the Schedule K. Now remember, we've got the Schedule K1, which is the report for each individual partner, right? That's what each individual partner gets and receives in order to prepare their own tax return. Well, all of that information on the K1 comes from this Schedule K. Schedule K, though, is for all of the partners. So ordinary business income, this would be from page 1, line 22, up here. Oops. And then we've got a bunch of separately stated items. Rental income, guaranteed payments, and so the guaranteed payments obviously this would be in total, but on the K1s, it's going to be per partner. Dividends, capital gains, all those separately stated items. Balance sheet. For most partnerships, well, I shouldn't say for most, some partnerships are required to have a balance sheet as part of their tax return. This would be the balance sheet per books. So whatever is in the financial statements, and then there is a reconciliation between net income per books and net income for tax. Because remember, we've got some differences between financial accounting and tax accounting, right? Our depreciation is gonna be different, right? For financial accounting, the total depreciation is gonna be different than our depreciation calculation for tax purposes. Certain other items are deductible they're expense items on the financial statement, but they're not expense items on the tax return. Think, well, in 2021 it wasn't different, but meals, remember we talked about the fact that meals are usually only 50% deductible on the tax return, but on the financial statements they're gonna be 100% expensed. So that's gonna be a difference as well. There are certain other types of items as well. So like the guaranteed payments would be subtracted for tax purposes, but they might not be subtracted for financial purposes. This part here is the reconciliation. This probably causes as much headache to tax preparers as anything, but it is necessary. You have to reconcile the difference between your books and your tax return. If you were taking business tax, you would get to work on that kind of stuff, but we're not taking business tax. This is a good summary of ordinary items and then separately stated items. So all of these items would be included in our calculation of ordinary income, like on that line 22, ordinary income. This. So all of the ordinary items, all the ordinary income items show up on page 1 of the Form 1065. All of the separately stated items show up on Schedule K. So this is an example of different items. So gross profit, ordinary income, salaries and wages, all these items. Separately